Good morning. Thank you for joining us. Welcome to Fundamentals with Matt Burk. I am your host, Matt Burk. You're on LinkedIn Live. Appreciate everybody being here today. I have a guest with whom I'm extremely familiar. I'm just been a couple weeks since I've done the live show. I was in Ireland the last couple of weeks playing a little bit of golf, which Kellen I know appreciates. And we'll be able to, in fact, we could get sidetracked to talk more about than funds today, but we'll try our best not to do that. But anyway, my colleague Kellen Stevens is joining us today. Welcome, Kellen.
Thank you, Matt. Glad to be here.
So Kellen's been with Fairway and Verivest stints at both companies over the last quite a number of years. And I don't know, Kellen, when was it that you originally came to Fairway? This is 2000.
It's between my stints at Fairway and Verivest. It's just over 16 years. So I want to say, 2000, summer of 2005, I think, is when I first officially joined as a marketing rep over at Fairway.
Yeah, so Kellen, looks like basically you came out of high school, I guess, with us, huh? Because you're not an old guy like me.
Not an old guy. Certainly not out of high school.
Still pretty young. So anyway, Kellen, Kellen and I have known each other for a long time. So I think the reason we decided to have Kellen on is he's got a great deal of experience on dealing with managers who are looking to set up and run pooled investment funds. In fact, Kellen's been on the front lines for many years of talking with these kinds of managers, going all the way back to when we first started doing a lot of the advisory work coming out of the Great Recession back in 2012. So Kellen has a tremendous amount of background experience, and I thought it'd be interesting to have Kellen share some thoughts around what managers are kind of looking for, what you see as some of the issues people are trying to solve, what some of the goals they're trying to achieve, where you see there's misconceptions and so forth. So maybe I'll start with Kellen. I know you're again on the front lines talking to these guys. Paint a little picture of what you see as a typical emerging manager or syndicator that's kind of coming in and looking to set up a fund for the first time, and some of the things that they're going through and the pain points that they're trying to solve for.
Sure, Matt. I would say a couple different fronts. You're getting emerging managers who are looking to, fundamentally it always comes down to velocity of capital. And they're looking to try to find a way to expedite the process to raise capital more efficiently without being under the time crunch that a typical syndication can present. So a lot of managers will, if they've done a few deals and they have a decent track record, and that varies for every client, right, Matt? But fundamentally, they've done a few deals. They have a good deal velocity in terms of they don't have the issue of originating or finding opportunities. It's really matching the speed of which they need to close deals to their ability to go raise capital. So a lot of clients will then are under the perception, and some may be a perfect fit, some maybe not, depending on their strategy. But that's when they start engaging or having the discussions around creating a pooled investment vehicle.
Yeah, and what do people, in your experience, when they start thinking about this concept? And I agree with you, right? A lot of it is that the one deal at a time syndication model becomes burdensome from a time standpoint, or you get held back, you got a fire drill you're trying to do every single time. So a fund seems to be a solution to that problem. When people start thinking about it, where do they go generally? I mean, besides, obviously, they can call us and we have that conversation, but where do they typically go to get information about what it means to set up a fund? And what do you find that they're when they're out searching, what are their options?
Yeah, I mean, a couple different sources. I mean, certainly there are, you can find groups, whether it's on LinkedIn or through conferences, that are selling advisory or fund creation. I would say the most traditional one that I tend to see is they go to an attorney, a securities attorney, to help them set up a fund. That has been the case for as long as I think has been the standard go-to. And I think it's fine. I think for a lot of clients, unfortunately, where they need more help around the fund is not so much the legal, and the legal is a very important aspect. I mean, you have to have the docs dialed in, they have to comply with security law. But I think a lot of clients also need that guidance and support around the business components, the economics, the fees, the waterfalls, the structures. And that's where I think, certainly we add a lot of value to that, but that is for a lot of clients a critical component in terms of the guidance that they're looking for. And look, and some attorneys do a really, really good job. But fundamentally, as you know, Matt, like living in the fund manager world and raising capital is a whole nother animal. So yeah, that's what I typically see.
Yeah, and then when they come to you, then and you have these initial conversations with them, what do you think some of the main fears are that people have coming into the whole notion of running a fund when they've never done it before?
Yeah, I mean, it's always around primary. The number one is raising capital, right? I mean, that's always the number one fear, and that's a fear that ranges all across the board, right? But that, especially for first-time fund managers, raising capital. I think the other fear that I commonly see, Matt, is just understanding how the economic structure works, because in a pooled investment vehicle, it's a very different structure, again, depending on the asset strategy in the pooled fund compared to a syndication. And we see that a lot, especially with deals that are more heavy value add or development related, and helping clients understand that economic structure and when they can take their promotes off the table. It's a far different strategy. And for a lot of clients, I don't think they fully appreciate that or think about that until they start going through the process and understanding what that looks like for them as compared to what they're, I guess, used to from the syndication model.
Yeah, and as they start contemplating the whole fund structure and they get into the discussion, where do you find that they kind of gravitate toward in terms of what is most important to them and what's not, right? And when they're deciding whether or not to set up a fund, like what are the most important considerations that you think people have?
Yeah, I think the one thing that I always try to guide in my questions when clients come to us about setting up a fund, first and foremost, it's always the first question of why do you want to start a fund, and that answer varies quite a bit for clients. The common answer I get, well, I want to have a fund so I have the capital, so I can just go out and do deals and have money readily available. Okay, yeah, that makes sense, and that in a perfect scenario, if you had that and it all works out, that's a great theory. I always tell clients backtracking. The other question I typically ask is deal velocity. What is your strategy, and how many deals do you typically see? Because I'm not always the proponent of setting up a fund makes sense for everybody. Depends on your deal velocity. So if you're doing one or two deals a year, even if they're larger deals in terms of equity check size, you may not need to start a fund. You can continue to do the syndication. If you're doing more.
So how do people know if they are ready or not? Like, is there some way to determine that, or how do you go about sort of assessing whether you think someone's ready or not to set up?
Yeah, I would say it's the line of questionings that I have, Matt, is around, as I previously mentioned, why do they want to start a fund? What is their current strategy? How many deals are they typically doing in a 12 to 18 month period? What's their current method of raising capital? Do they have the ability to grow and expand on that? Have they talked to their existing investor base about launching a pooled investment fund? That question comes up quite a bit because, look, I mean, an investor may be more content or per their risk-adjusted return, like syndications, than investing in a pooled investment fund. So there's a number of those type of questions, and we'll go through that kind of Q&A process. And I always want to be an advocate for the client. So if I think based on their answers and their experience and their track record, and as we go through the process, a fund makes sense, then we'll continue the dialogue. If I don't think they're ready, or we don't think their strategy is a good fit, given how they answer those questions, we'll tell them that too.
So are there certain types of strategies in your mind that are more conducive to a fund than others? And if so, kind of what are the ones that are conducive and what are the ones that are not?
Yeah, I would say certainly for all clients that I talk to, I mean, you can certainly do a fund in a matter of strategies. I would say the ones that are most conducive, Matt, for a fund, mortgage pool notes, anything with a high velocity of deals that are turning over quickly, a fund makes a ton of sense. So if you're doing bridge lending or doing some sort of debt vehicle, those make a ton of sense. The ones that may potentially be a little bit more challenging are really more of those development deals. And I say all that, Matt, doesn't, as you know, doesn't mean you can't do a fund around, but understanding the deal velocity, as I mentioned earlier, may or may not be conducive for a fund. Also, for managers understanding the economic waterfall is a big proponent as well. They need to understand, especially for development deals. In a traditional fund model, they're not taking their promotes right every time a deal goes full cycle. So if they have 4 or 5 deals in a fund, certainly you can do it, but understand it's, as the GP in that fund, you're kind of on the tail end of the promote at that point, which again doesn't mean a client can't do it. It's just understand they need to make sure they understand that in terms of how those economics work.
Yeah, and looking back on all the, I mean, it's in the hundreds now. I don't lost track, and we need to actually one of these days go and really figure out exactly how many we've done. But what are the kind of, once people launch, what has been the typical size and scope and scale that people are able to get to in a funds? And obviously it varies, right? I mean, some people barely get off the ground and some people kill it, but what does killing it look like? What does average look like? How big do you think, a manager can reasonably expect to get starting off on a first time fund?
Yeah, I think that's a great question, Matt. I think a lot of that will again be driven by the manager's current investor base and overall strategy. I think every manager has different, I would say, objectives in terms of what is a successful fund, right? For some managers that we deal with, their ultimate goal, especially for a first fund, is get to 10 or 20 million, and that's kind of their, prove it fund. Others have ambitions to be, 50 million, and then the others want to be at 100 plus, and it really ranges in between. I would say for the typical client that we are likely, that engages us is in that emerging middle market space, and they're looking for, at least in an initial fund, somewhere in that 10 to 50 million dollar range would be a successful offering.
Yeah, is there kind of a minimum number in your mind that makes any sense for people to, like, below which that doesn't make sense to do a fund? Or
Yeah, that's a really good question. I have always, kind of held fast that based on your asset strategy, 5 million feels like a minimum, 5 to 10 if you want to be on the smaller side, because at that point, especially anything less than 5 million in terms of investor capital managed, it's a lot of work for probably not a lot of profit at that point. So that's just kind of my general range, I would say, in terms of a minimum.
Yeah, I think that's accurate. And I'd say, like, to your point about velocity, the greater the velocity of assets, meaning the faster they turn over. If you're doing a bunch of small deals that turn over every 6 months, like, like short-term bridge loans, or you're doing fix and flip, or you're wholesaling houses or something, a little bit of money goes a long way, because you can recycle that dough right back into new deals. You pay out the profits, but then you redeploy the capital, and you don't need as much money because you're turning it over more rapidly. But if you're sitting on property or assets for 4, 5, 6, 8, 10 years, then that money just gets tied up. You got to raise a lot more money to do the same deal volume. So, I think there is no absolute answer to what a minimum is, but I agree with you that anything below 5 or 10 generally just doesn't make a lot of sense. You're probably better off to just syndicate. How does when people are thinking about setting up a fund, what can they think of in terms of costs to just get it off the ground, and then what are some of the ongoing costs that people will have to operate the fund, after they get going, that they may or may not think about?
Yeah, I mean, I would say the cost can vary, and that'll vary depending on where you go. And certainly, Matt, as well or better than I do. I mean, that the cost range is all across the board. I mean, I've
Well,
had
just say generally ranges in the marketplace if someone's thinking about setting up a fund, not necessarily just with us, but if you go anywhere,
Yeah.
How much can somebody reasonably expect to spend in order to be able to get the thing off the ground? And then what are some of the ongoing costs associated with running the fund?
Right. And so the range could vary anywhere, I would say, 20,000 to 50,000 in terms of setting up the offering. And I've seen it as high as 100,000 before. So, but 20 to 50 is the general range that I typically see. The other additional costs, I mean, certainly if you're running a mortgage pool fund, there's loan servicing. The other big one for a lot of clients is obviously the fund administration on the back end piece. And that is an ongoing fee. Now, that is a fund expense, so that's not an opco expense for the manager. So it's always important to remember that, essentially the investors, are bearing the cost as the fund grows. But that is for all the accounting work in terms of having a third party administrator help you with the waterfall calcs, the investor statements, obviously having the technology platform for a portal, all those things. And there's obviously a wide variety of those services, but that'll probably be your largest ongoing expense from a manager perspective as it relates to once the fund's off the ground.
And do you find that investors object to doing that, or are they okay with bearing that expense given the oversight and the third party, kind of objectivity and so forth?
I would say, I would say most investors, I guess it would probably depend on the level of, your retail high net worth investor and obviously the size of the fund. I'm more bullish to, putting my investor hat on, having a fund that has a third party administrator, and it has nothing to do with the manager or my trust or their ability to perform or act ethically on my behalf and be a good steward of my money. I just like I like the transparencies and checks and balances that come with having a third party do the admin. And by and large, I think, Matt, that's what a lot of investors are most interested in, especially when you're dealing with turbulent markets, turbulent times, not sure what's happening. I think a lot of investors like having that third party, even if it's a cost to them. The cost compared to the return and the peace of mind, I think, is well worth it.
And has that become more prevalent, it seems like, over the last few years? I mean, like I don't recall like fund administration even really being a thing for small managers years ago, but it seems like that's gotten more and more common. I mean, the institutional world, having an administrator is table stakes, right? You can't get an institutional investment. I mean, that's just the way it's done. But in the high net worth world, it's been a little bit all over the map. What's been your experience there in terms of the trends in the industry?
Yeah, I would say you're seeing what was the standard at the institutional level has come downstream, in my experience, Matt, to where even if you're launching a new fund in the new emerging middle market space, you're seeing more of the investors request or even demand, having a third party administrator into a fund. And that, like, to your point, that was not the case when we first started doing the advisory back in 2012, 2013, as much, especially at least in the, middle market emerging space, right? It's becoming, I think, far more of a prereq, I would say, for investors, even in the sub-institutional. When I say sub-institutional, I mean size of fund space is becoming way more prevalent.
What are you experiencing out there right now with respect to like interest level on managers setting up a fund, especially given the sort of uncertainty and the turbulence in the market? I mean, are people still actively considering setting up funds, and how are they viewing, the timing of doing it now, given, what's going on? Is it a positive? Is it a negative? Like, what are you hearing out there?
Yeah, I would say you're still I'm seeing more on the debt side is still probably prevailing a lot right now based on the current market conditions. I would say though, we are still seeing a lot of activity for clients wanting to set up a fund, even in the acquisition. I think a lot of it, Matt, is they are, everybody wants to try to stay ahead of the curve, right, as much as they can. And it's a little bit of forecasting and projecting, and nobody really knows. But I would say in general, clients are still actively, especially they feel like they want to be ready and poised when the market turns. If they get good buying opportunities, if the seller interest starts to align better with the buyer interest. Everybody wants to be, they want to be jumping in before the game starts, not when it's in the seventh inning, to use a baseball analogy, right? I mean, so so you're still seeing that activity, and so a lot of the clients, especially in the acquisition side, are teeing up their funds to be ready for either later this year or into 2024, based on what they're hearing or seeing in the market. So certainly, I'm still seeing and hearing a lot of activity, but it's always coming with, and I would say this is, some of our best clients, and certainly the clients I enjoy talking to, certainly understand that there's going to be headwinds, there's going to be challenges. Raising capital is difficult. It's difficult in any market, right? I mean, but for the clients that I think are really going to be successful, they understand, those challenges. They're trying to mitigate the risks the best they can, and really be ready for when there's good buying opportunities.
If you think back on all the clients, and I know it's in the hundreds, thousands even, of conversations that you've had over the last decade around people setting up funds and all of that, what was the most unique, without naming names, like what's the most unique or sort of weird or crazy strategy that anybody ever came through with to set up a fund around?
Oh boy, there's a variety of them. I mean, certainly we've seen, I would say you see all sorts of unique, storage facility structures, with, shipping containers, certainly conversion opportunities, which are more prevalent now, but when we were first seeing them were super unique, in terms of those strategies. What else? I mean, you can probably name.
Yeah.
I can't. There's a wide variety. And look, and I would say all that, tying it back into, I love anything that has an opportunistic nature to it. I love opportunities that are outside the box. Within reason, there has to be a good strategy behind it. Ultimately, makes sense. But certainly there's all manners of different types of funds. I've even had some approach me about creating funds around, buying and or developing amusement parks and water slides and, outdoor, and so you come across all kinds, type of thing. So it's always funny when I'm on the phone, because having done this for so long, I always enjoy the conversations where everyone thinks they have a unique strategy, and odds are I've heard it multiple times.
Yeah, you're the fourth guy this month that we've talked to about that strategy.
Yeah,
like they want to sign an NDA before we even reveal it. And you're like, oh yeah, that's not.
I heard it a month ago. Everybody's got, so it's always, which again doesn't make it a bad strategy. It's just, having done this for so many years and been on so many calls, there's a good chance that I've heard every strategy, at least to date, at this point. So
yeah,
but you never know. I can hear one this afternoon that I've never heard before. So
every now and then you get one that surprises me, but for the most part, they're a lot of the same stuff. So any advice that you would give to an aspiring syndicator who's thinking about setting up a fund? I mean, just like summary in all your experience, I mean, what would you say to someone who's thinking about setting up a fund and, really not sure what direction to go?
Yeah, I would say certainly, one is do an internal audit of your own deals, your own track record, your investor base. That will help a lot better assess internally. And, and along with that, Matt, is just be honest with yourself. Like, are you ready? Do you want to take this on? Like, there are certain things, as we help clients through that advisory process and go through that holistic perspective around helping set up their funds, that we can provide a lot of guidance. But certainly you're going to take a plunge, right? Especially if you're a first-time fund manager, and you're going to learn as you go. So I would say, doing the internal audit, making sure you have the right deal flow, that you have at least, you have that initial interest from investor, or your existing investor base is open to doing a pooled investment vehicle. And then, and finally, then once you launch the fund, do not be afraid to try multiple things. Raising capital is difficult, and what worked for somebody that you may not work for you, and vice versa. So be willing to get yourself out there, try different methodologies, whatever that may be. And then we could do a whole nother series on just the different ways to go out and raise capital. But I would say the most successful people I've seen have just been steadfast in their resolve to raise capital and have tried multiple things, and they continue to try things until they find a vein or two that really works for them. And then once they do, that gives them the access to go raise capital and continue to grow organically.
Yeah. So I know you're a big learner and listener to audio tapes and all that stuff. Anything you're listening to these days that strikes your fancy that you want to share with our listeners on some high value content or material that people can benefit from?
I listen to a lot of different podcasts, a lot of different audibles, as you do as well, Matt. I always tell you, there's always information. Some of it may or may not be as relevant to you. A couple of pieces that, and this is just more historical, that I could not recommend more to anybody who's doing anything in the sales arena, relationship management, negotiation. Mahan Khalsa, Let's Get Real or Let's Not Play is, I've probably listened to that more than 20 plus times in the last decade. And there's always something new or something maybe I forgot that I can take away from that, or just trying to stay, continue to develop and maintain good habits when you're talking and asking questions. The other one I would say I have found super beneficial is Jeff Toole, Mastering the Complex Sale. Great approach in terms of easing clients, accepting no as a viable answer, just how you communicate the process, whether you're on the phone or communicating through email, just the overall messaging. So I would say those are, of all the audibles, and there's certainly a lot of other good ones that are out right now. Those two have always stuck with me, Matt, in terms of just the ones I always kind of circle back to in terms of advice and guidance.
Yeah, they're both extremely good. How do people get a hold of you? They want to reach out. Like, what's the best way to reach out and get a hold of Kellen Stevens?
Best way to reach me, one is email. So it's Kellen, KELLEN.Stevens, and that's Stevens with a V. So STEVENS @verivest.com, or you can call me 503-906-9113. Both are good. Or, I'm on LinkedIn, so feel free to message me on LinkedIn as well.
All right, man. Hey, it's always good chatting with you. Appreciate your taking some time to be on the show. Hopefully people got something out of that today, and the whole, we're really focused on the fund arena. So hopefully that's of some help to some people out there, and appreciate you being here. Please join us again next week. Same time, same place. I will not be in Ireland next week. So we're playing golf. So we'll be back here next week with the next show. So thank you for joining us. And in the meantime, stay sharp.